Hello and welcome back. I wanted to make a video that is dedicated to inflation because a lot of you may be hearing that inflation is going higher and higher these days, not only in the US but worldwide, really. And you may be thinking to yourself, okay, I understand that prices are higher now, but why do I care as an investor? And the thing is, as an investor, you really care about inflation, and especially if you're a stock trader or a stocks investor, or any investment really is affected by inflation, and you need to understand how that works. And so I wanted to kind of break it down for you, and in case you are not very well aware of what this means for you as an investor again, I will give you some of the important disadvantages of the current situation in terms of investing into the stock market. So as you can see here in December 2021, the US inflation rate hit 7%, which is the highest figure since the Reagan presidency, the seventh consecutive month of above 5% inflation. Typically, you want an inflation rate that is sitting at about 2 to 3%, because this is when the stock market is actually thriving. Historically, this tends to do best for stock markets. Now, you will see that President Biden is obviously under some pressure to bring this under control and all that. But it's interesting to see here in a separate article from the Wall Street Journal that in 2021 there was a study in which Professor Harvey and some co-authors of his looked at 8 periods over the past century in which US inflation was 5% or higher for at least 6 months. We are sitting at 5 months right now, and found that the inflation adjusted return on stocks averaged minus 7% annualized. So you are seeing here that stocks are very heavily affected by inflation, and this is what brings a lot of concern to us and should be concerning for us when investing in the stock market, and especially when investing in stocks and companies that have been hyped up beforehand, and they have been losing a lot of its value because of this new current climate here. And as you will see here, it explicitly says that based on his research, they suggest shifting money from the worst performing sectors during inflation, which include consumer durable stocks such as automakers, and into the energy and natural resource stocks that tend to fare best. And that's because we need these things. But when a recession hits and when interest rates are high, automakers have issues because not a lot of people are actually willing to get loans and get indebted just to get a new car. And this is why investing in companies like Tesla, for instance, or other EV companies, or any car companies really, is kind of dangerous when inflation is getting higher and higher. On the contrary, historical data suggests that real estate investment trusts, REITs as it's most commonly known, they tend to do well because raising rents is the norm, and rents tend to actually increase based on the interest increase as well, based on the inflation. So the more inflation increases, rents tend to increase likewise for the most part. And another potential asset is commodities again, because they tend to hold their value and even sometimes outperform in inflationary surges, is what we have discussed in some previous videos as well. The other thing that you may want to be holding when these types of events happen is companies that are non-discretionary in nature, meaning that people actually need them to survive. Like, for instance, everybody needs apparel or everybody needs food, things of that sort. So, like fast food companies, for instance, or discount stores like Walmart, for instance, tend to do rather well in these kinds of situations. And now I wanted to talk a little bit about some of the details about inflation so that you better understand again what this is about and what causes the fuss for and a nightmare really for investors, as you can see here. And simply put, I mean, inflation, pretty much everybody knows that this is how much the ratio of increase really, how quickly prices are increasing in an economy. And you will see here that inflation, as the article points out, actually affects products that we buy because they are now more expensive. And when you are hearing about a 7% inflation, that actually accounts for a basket of products. It's a well-known basket of products that we get an average from. But then there may be other products that are actually more expensive, even more expensive, so they have higher inflation. And overall, we get a value for all of these products, and sometimes it may actually be lower than some of the other products that are really, really increasing in terms of their prices. And so the thing is, some companies, really all companies, are also affected by these increases because they, for instance, require raw materials. And so these materials are increasing in price as well. The other problem is that when we're talking about the wages of people, they do not really tend to adjust with inflation for the most part. They don't increase so quickly as inflation, if inflation is that high. And so if you're having an inflation of 10%, level of 10%, and people's wages are increasing at a 5% level, then this means that people are getting poorer. And so that means that actually people end up buying less stuff, and they don't have the luxury of buying cars. They have to be buying essential things like food, for example. And this is why investing in companies like EV makers, for instance, or other discretionary companies that are not really required for daily life, can be a problem here. And this is why these kinds of companies tend to be dropping very, very quickly as well. This could also be tech companies, for example. So profits now are worth even less, of course, because the higher the inflation is really, the less of a profit that an investor makes out of an investment, because inflation eats up their money. And so it's different for me to invest today and make some money tomorrow that's going to be affected by inflation at a level of 2%, and it's different if it's affected by inflation at a level of 7%. I may want to be finding some less riskier investments that I know will be yielding some money for me. And this is why when interest rates rise, and this is what happens typically with inflation, some other types of investments tend to become more interesting, like for instance bonds. And there comes a point where if I'm making, let's say, 10% out of a bond, why would I want to invest in the stock market? I mean, a bond is way, way less risky, and a 10% gain is guaranteed for the most part. While the same thing doesn't even remotely happen in stocks, where there is a much more risk there. And so, what do central banks do in order to fight this type of inflation when it happens, as it's happening right now? So, when inflation exceeds some level, let's say, as the article points out here, generally speaking, it's like 2%, because they want to be keeping inflation at about 2 to 3%. Again, it's best for the market. So what central banks do is increase interest rates. Why are they doing that? You may want to ask. Because when you're increasing interest rates, you make it tougher for people to borrow money, because now money is more expensive. It's different to borrow, let's say, $10,000 and pay an interest rate of 5%, and it's different to pay 15%. You obviously are going to be borrowing much less. Overall, people are going to be borrowing less money. And so when people are actually borrowing less money and hoarding money, inflation goes down, because there is not an increase in prices, of course. People are not buying all of a sudden. And this is why there is this correlation between inflation and rising interest rates. Typically, the central bank tends to increase these interest rates in order to bring down inflation. But the problem is that when interest rates increase, this is the kryptonite. It's a kryptonite for the stock markets. So this potentially gives you an idea on why this is very, very problematic for the stock market. And this is why, even as a cautious investor, you need to realize that this is a risk, and you need to be mitigating that risk by purchasing companies that have decent cash flows, can survive if things go down for a couple of years or 3 years, which is typically how much it takes for the company to regain some steam. And so this is why I'm talking a lot about cash flow, and this is why I'm analyzing companies in terms of cash flow. Because if you buy, let's say, Alibaba, which is a company that we have been talking about a lot, today, and then there is a problem with the stock market just because of rising inflation, and now we are in a recession. Alibaba has a very, very decent position in terms of its finances, has a lot of free cash flow to survive through 2 or 3 years or more. But if you bought Peloton, then there's a problem because the company is actually losing money. They don't have any cash flow. The cash flow of the company is basically what investors are willing to pay to buy the stock from them printing more stock or the debt that they're getting. And so this is, and also the fact that bicycles are not going to be like the training equipment really, or gym equipment is not going to be bought a lot by people, because if there's high inflation and people are poorer now, probably bicycles are going to be like training exercise or gym fitness exercise. It's probably going to be the least of their concerns, right? They want to be buying food and apparel and things of that sort first. So this is why you need to keep these things in mind and have a very, very designated portfolio in your mind to actually account for this possibility, because it is a possibility. And so I hope that video kind of gives you an idea of how to approach inflation and actually understand why inflation can actually really, really hurt your investments. And I want you to heed that advice and be careful about what you invest into the future, just because there seems to be some issues happening right now with economies, and we may be for some turbulence really in the markets in the very near time really. So thank you for watching the video. I hope that helped you a little bit understand what are some of the dangers in terms of inflation. And if you did enjoy it and you learned something today, please leave a like and subscribe to the channel. And you can also join our Discord channel. You can find the link in the description box below. And in the meantime, take a look at this video that I made earlier, and it's about Nintendo. And always bear in mind that Nintendo can be affected by inflation too. So thank you for watching, and I'll see you soon. Bye bye.